You are listening to Fast Track Podcast, the place to be to fast track your personal finance or fast track your business or both through a series of conversations with those who have learned it, done it, and made it. Today I have NingXi as my Fast Track Podcast guest, and she is a private investor with a diverse portfolio spanning real estate across the US and investment in private companies. Before stepping into full-time investing, she worked as an investment and data analyst at top investment management firms in the New York City area. In 2022, she made the leap from the 9-to-5 world to focus entirely on growing her own investments, while also embracing the freedom to explore life's opportunities beyond the office. She is excited to share her journey, insights, and lessons learned on the Fast Track podcast. So welcome, NingXi.
Thanks for having me. I'm excited.
I know you already for more than a decade, and it's so interesting for me to see you are initially working. I think initially you were working at NGO, and then later you did additional studies, and then later you did completely different work, and now you are completely independent and you open some kind of like yoga or fitness studio. And now as a real estate broker, like you really took a different path. So I'm curious, you started with real estate investing and become a real estate broker in the US.
Yeah, my path has been quite unconventional. I did liberal arts in college and I went to business school, and I always knew I would probably work in business or finance one way or the other. And I got started with real estate just before the pandemic, really at the time as a way to get a supplemental source of income. I didn't think I could leave the 9-to-5 world right away. Obviously, that was a goal in the back of my head. So I started right before the pandemic. So I started following bigger pockets. I was reading the forums, listening to the podcast, and just trying to get as much information as I could. So I started with my first property was a condo. I was actually an out-of-state investor. Um, so it was a little nerve-wracking. That was probably the most nerve-wracking deal I've done, even though it was probably one of the simplest. Yeah, from then just I was able to take advantage of leverage or the credit that I had and finding good deals and just scale from there onwards.
And a little bit more about your first investment. How did you decide that is a good investment? What's your thought process, and what is the process that you need to invest in out-of-state property? Do you need to travel there often, or is there someone there locally that you can give the power of attorney to help you to do that?
So my first property was in Austin, Texas. I picked the market because I thought it was a market with good growth potential. So fast forward 2 or 3 years into the pandemic, that was the right prediction, even though for the past couple of years that market has come down somewhat. But I didn't know anyone actually at the time. I went down there once or twice and went on tours with different agents, and I picked one property that I liked. And when I closed, it was actually all remote because I was in New Jersey at the time. So my agent went to the walkthrough for me, and then I was able to close remotely. And then since I closed, I went down there once. It was actually like the beginning of COVID, and I was doing some showings myself. But then it's been more than 5 years at this point, but mostly it's been remote. I probably have been there on average less than a year. So I was going down there more often in the beginning, but now not really at all.
What is your decision-making process? How did you know that is the one you're looking for?
Oh, the property, you mean?
Yes.
I wanted to be in downtown, and I was looking for my budget. I think I could have gotten a two-bedroom or right on target, but then I found this one bedroom in a really like desirable location with a building with good amenities, good management. So I was able to hit like pretty a lot below my budget. So that was good. That left me some capital that I actually was able to leverage to buy a condo in New Jersey that I lived in. So I had probably a few to choose from, but I just felt the most comfortable in that neighborhood, in that area. And I thought it would be easy, a place that would be easy to rent.
Besides location, do you have other criteria on your checklist?
Yeah, so because I was buying into a condo, it was important to make sure that I would be able to rent it out because some buildings have restrictions when or like what time of the year you can rent your unit out. So this building just cleared. No, I was able to clear all the requirements. I think the requirement is no more than 30% of the entire of all the units could be rented at a time. And it was only like in the teens, so I knew I wouldn't have any issues. So that was also one of the criteria.
You feel afraid, or is a big step to take?
Yeah, it was definitely scary, and it was probably the most scary and most exciting deal that I've done, even though looking back, it was just a small deal and a pretty straightforward one. It probably took me just about a year from starting to be interested to actually jumping in. Also because like around the beginning of COVID, that's when interest rates were basically crashing in the US. So I really just took advantage of that. Because when I talked to a loan officer, he basically said, I've been doing this for 20 or 30 years. I've never seen a rate like this. Like at the time, it's like 3%, more or less. That was an indication that if I want to buy, I should just seize a moment then. And I'm glad I did because now I probably will probably never have that rate again in our lifetimes.
So from that property, how did you go on to invest in other properties? Can you tell us more about your investment journeys in the past 5 years?
Yeah, from there, I think, I got a really good deal just outside in the DC area, just outside DC in Northern Virginia. And it's a very low priced building because it's on a land lease. So a lot of investors tend to stay clear of land lease buildings because the buildings don't own the land. So once the lease expires, the HOA fees may go up significantly, or the owners might even lose the property. So the land lease at the time would expire in over 30 years, would expire in the 2050s. So it was a really great location because from that building you can walk to DC. So it's a very good location, close to subway, lots of things to do, but significantly cheaper the other buildings in the neighborhood because it's a land lease, it's an older building, it doesn't have all the bells and whistles. So that's just I saw as a very good opportunity, even though I knew I was taking on the risk of basically losing the property when the land lease would expire. But in general, I'm more of a cash flow investor rather than appreciation. I did the math and realized I could cash flow per month at a pretty decent level, enough so that if I could keep this cash flow coming every month for 30 plus years, even if I just lost the property when the land lease expired, I will be happy with it. So I think it was a pretty much a no-brainer for me at the time, even now, I think, but also because a lot of people, like, as soon as they hear that it's a land lease, they won't even consider it. So I think that helped.
And that was the second one.
Yeah, that I bought to invest. Yeah.
Okay. Did you buy more later on?
Yeah, actually, at the time I bought two units in the same like apartment complex in two different buildings. And then, yeah, because of the unique situation, because it's actually a co-op, not a condo. I don't know, probably in Europe there is a similar concept, but co-op basically means it's not real estate, it's personal property. So it's harder to get a loan, but there were like two specific lenders that were working with the building because of the fact that it was a co-op and because well, it was on a land lease. So I didn't really have a lot of financing options, which is basically two lenders. But still, it was a great deal, even thinking back on it now.
So you mentioned a lot about you're doing your math and then the numbers is right for you. For anyone who is interested in investing in real estate property, what kind of numbers should they look at?
The cap rate is probably the most cited number. It's essentially it's an indication of what return you're getting. So how much you can expect to, from an income perspective, get out of the building, the property versus how much you have to put in. And it's also a useful indicator because it's financing agnostic, meaning no matter doesn't matter where your down payment is, your cap rate will remain the same. So whether you're paying cash or taking out a 95% mortgage, the cap rate does not change. That's a kind of baseline metric. So I think it helps to think of it as like your return on capital because it's the income you can expect to get divided by how much you're paying now. And then your interest rate, if you're financing, then your interest is basically your cost of capital. So if you compare your return on capital versus your cost of capital, it's like what you're paying for versus what you're getting back. Ideally, your cap rate should be higher than your interest rate. There are also other metrics like your cash on cash return, but that's going to be impacted by leverage. So the less you pay upfront, less cash you pay upfront, the higher, potentially higher the cash on cash rate will be. But because it's leverage and leverage obviously is a double-edged sword. So if the investment pays off, your cash on cash return will go up. The less you pay, higher the return it will be. But if you have something called a negative leverage, meaning the investment doesn't pay off, and if you're borrowing a lot of money, then you're much worse off than if you had paid cash. Yeah, cash on cash return versus cap rate are usually the two indicators that I look at. Mostly, I would say more so on cap rate.
And what is the percentage of those two indicators do you think would be a good investment property in the US?
Now it's hard, in a lot of markets, it's hard to get a cap rate higher than your interest rate because interest rates are so high, in the sevens or maybe like high sixes. So if you can get a property with a cap rate of 7%, that's usually a pretty good deal, but they're hard to come by. Maybe we'll talk more about it later on, but it also matters. I think it's easier to get a higher return if you're doing short-term rentals versus long-term rentals, but short-term rentals are more work on the owner's part. With respect to cash on cash return, it really depends on how much down payment it is, because the lower the down payment, the basically your cash on cash return gets a boost. In a very good deal, if you only pay 5% down and you borrow 95%, you might get a cash rate like in the teens or even 20%, but that would say those would be very rare.
And then when you look at the cap rate is the expected yearly rental income divided by the total, the price of the property, right?
Yeah, so it's NOI or net operating income. So your annual rent minus your expenses like property taxes, HOA fees, if it's a condo, insurance, like maintenance, utilities. So your net operating income divided by your purchase price. Purchase price would include your closing costs as well because
Mm.
you're paying, a bunch of fees when you buy.
Okay, then one has to make some assumptions based on how what's the maintenance cost, utilities, etc. So to be on the more conservative side, then if you take a higher number on the cost, then that will lower your cap rate.
Right. Yeah.
Okay, and how do you estimate the rental income or net rental income in a market that you are not living there?
I would start with the top line where your gross revenue or gross rent. Pretty much you can get the numbers anywhere. If you just go on Zillow or any of the websites or like HotPads, you can look at what your neighbors are charging. If it's a building, it's probably even easier because in a building, you might have your neighbors upstairs, downstairs on the same floor with the same layout, same size. If you see what they're charging, that's pretty much how much you can charge. If it's a house or single family house, and you might have more leeway in playing around with how much you can charge, but still everything depends on the market. So I wasn't really worried about that because all the numbers I could get online, like remotely. So that's a good starting point. And then property taxes, I think for all the markets I've invested in, at least like all of them are public. So you can just go on the county tax assessor's website, then you can get the numbers from there. The numbers can change every year. Usually they go up every year, but still that gives you like more or less a realistic idea. And then HOA fees, you can get that number from the agent. Insurance, you can probably also get a reasonable estimate. And then it's also important to have a reserve number plug in because your property will experience wear and tear over time. That's the nature of the beast. So what I like to do is to just give a monthly kind of allowance because sometimes you have a leak or if something breaks down and then you have to pay like 500, $1,000, but those are not your monthly expense. So I estimate how much I would need to spend on maintenance over the period of 5 years, and I divide that by 60 to get my monthly like reserves number. Yeah, so those are the main things. And if you're paying utilities versus asking your tenants to pay for utilities, and that's another expense as well. But all of them, I think, you can if you just do some homework, you can find out
Okay. Yeah.
ballpark.
Yeah. And then let's talk about tax. What are the taxes associated to owning a property and then renting the property?
You have your property tax, so that varies by state and by county, even by municipality. And unfortunately, like where I own properties like in Texas and New Jersey, they're like two of the highest in the country. But investing in real estate also gives you a lot of tax from an income tax perspective, a lot of benefits because all of your property taxes can be written off. So your gross revenue, you can write off all the expenses, including property taxes, to arrive at your net taxable income. That's in addition to depreciation expense, which is not really an expense. And then how it impacts your income tax, there are a lot of things you could do. I think we can still use cost segregation or bonus depreciation. I think now it's at 60%. It used to be at 100%, but now it's been going down year by year. So basically, you accelerate your depreciation expense up front. So on paper, you might have a big loss, even though your cash flow may be positive because of the depreciation, kind of like the phantom expenses. They're not actual cash outlays. So a lot of investors do like bonus depreciation to accelerate their property depreciation upfront in order to claim a paper loss, in order to get a tax refund. And sometimes that can be sizable, and they use that tax refund as a down payment for the next property. So it just goes onward. But obviously, at some point, you will have to recapture the depreciation expense. I don't know how it works in Europe, but maybe something similar exists. So for residential properties, you can depreciate for 27 and a half years. So that's basically your purchase price plus your closing costs divided by 27.5.
So
Using
the assumption is that after 27.5 years, the house value will be zero.
It's not really like an estimate on the property value will probably go up, but it's just the idea that even like everything inside the house can be depreciated. It's like if you buy furniture, you can depreciate it by 5 years. If you get a new cabinet, you can depreciate by 15 years. But for the whole property, it's just a 27.5. That's how many years you can claim depreciation expense.
But this is just assumption, right? It's not in reality. But for tax
No.
purposes, that the housing value is the value based on purchase price, or is the value based on government guidelines estimated price?
Purchase price plus closing cost.
Okay, and then divided by 27.5, then you can depreciate this value, and then it will be a phantom cost, and so you minimize your income tax. But after 27.5 years, you cannot depreciate it anymore, right?
No, when you sell, you have to recapture. It's called depreciation recapture. So if you claimed $100,000 in depreciation costs over the years, when you sell the house, that $100,000 will be added to your
Uh,
like profit or sale price. So you would have to, depreciation is always just a tool for you to shift around the income.
yes,
It's never free
yes,
money. Yeah.
yes,
So a lot of people do that 1031 exchange. So they sell one property to buy a bigger property, then they defer paying the tax. And then if
yes,
they keep doing that until they die, then it goes to their heirs.
yeah.
Yeah, that's how people like a lot of people play the game,
What is
essentially.
what is the tax rate if you sell the property for profit?
It depends on your overall income because it looks at all your sources of income. If you have a W-2 or you have a lot other investment income, and then yeah, it's
Okay.
considered capital gains, basically. Well, its capital gains tax rate is lower than income. It's gonna be lower than a regular 9 to 5 job.
Okay.
Yeah.
Okay. I see. But if you sell one and you don't buy another one, you have to pay back this depreciation. Like, it will be added as your assumed
Oh,
income plus the capital gain from the transaction, and then the tax rate might be higher than it actually.
yeah,
Yeah. Okay.
yeah. So actually, a lot of people run into this problem. A lot of properties are held in the same family for many years, maybe to like over generations. So a lot of people have this issue, and then they are in basically a time crunch to do a 1031 exchange because in order to do a 1031 exchange, there are strict timelines.
It's 1031 exchange.
Essentially, it's the idea that if you don't, if you sell this house and if you sold it, you will owe a lot of income taxes
Yes.
because all the depreciation recapture, then you can sell it and immediately buy a higher value property. Then you don't have to
Yes.
pay the capital gains tax.
Yes.
So it's right. It's a way to defer
Mm.
paying the taxes. So a
Mm.
lot of people just have no, they do this for life.
Okay, understand. So you just keep rolling, keep rolling. Okay.
Until you give it to your heirs.
Yeah. What about the financing? How many percent can up to the value of the transaction price that can people get a loan?
If you house hack, meaning if you buy a multifamily and if you personally live in one unit and you rent the other units out, then it becomes your primary home, and then you can, so if that's the case, you can borrow up to 95%. So that's a lot more leverage, obviously, but also more risk. But I think that's the easiest way to get started because you only have to pay 5% down payment. That's much more realistic than having to put down 20%. So that's a good way to get started. And then you can personally live in, if you buy a duplex, you can live in one unit and you can rent the other unit out, and your tenant will be paying for the
Oh,
house.
what if you live in a multi-family home with five apartments and you live in one? And would the lender still consider, okay, you live there yourself and then they give you this 5% down payment?
Yeah, I see what you mean. I think there is a cap. I think it has to be maybe under 4 unit because anything above that is going to be considered a commercial rather than
Mm,
residential because you could buy a whole building with 200 units. So I think don't quote me on this, but I think that there's a cap. It might be 4 or 3, but yeah,
mm,
to prevent institutions from taking advantage of it.
okay, I understand. And if people pay 5% down, they have to pay interest on 95% of the mortgage. Would that make sense for a lot of people to do that versus just paying rent?
It depends on a lot of factors because even if you're cash flow negative, meaning the rent from the tenant doesn't cover all your expenses, but even if you're only cash flow negative for $300, but consider the fact you're living there, and if you were to rent, the rent would be like, let's say 1,000, 2,000. I would take that. Of course, this depends on market.
In the scenario that you just pay for one condo, you live there yourself, and then you finance it with 5% down payment and 95% mortgage with high interest rate, and then the monthly interest that you have to pay versus the rent you have to pay. What do you think? Which one would be higher?
If you buy a condo, then you wouldn't be able to house hack because you have to live there or you just rent it out. Then I think that if you take an investment mortgage, I think the minimum down payment is 20%. Maybe some lenders can do 15, but I don't think you can just put 5% down. But that's actually this like maybe let's put house hacking aside if you just compare buying a condo and renting it out versus renting the condo for yourself. That's a common dilemma right now because in a lot of markets, in my market, including my market, it's cheaper to rent a condo or an apartment than to buy it even with 20% down. So if you rent an apartment, you could rent it for 4,000 or 3,000. But if you have to buy it and put 20% down, your HOA taxes, mortgage would be 5,000 or yeah.
So okay, even if you put 20% down, your monthly cost would be much higher versus if you rent. So imagine if people just put 5% down, and then the monthly cost would be even much higher than just
Yeah,
rent condo.
yeah, but if you house hack, then at least you're living there.
Yes,
Uh, yeah, also like usually like multifamilies have higher returns,
yes.
at least from my experience, because you're buying a building with 2, 3 units versus a condo. Also, there's no
Mhm.
fee. There are more things to worry about, like your roof, your foundation, but there's no HOA fees to worry about.
In this market, there wouldn't be a no-brainer choice for people to rent instead of buy.
I would still buy multifamily because if I were to, I'm not looking to buy anymore, but if I were, I wouldn't be interested in condos just because
Mm,
it just doesn't make sense because high
yeah,
tax, high HOA fees and maintenance. So I would be looking into multifamilies,
yeah.
do
I mean,
house hacking specifically.
yeah, because you're a real estate investor. For average person, like many other people who are not investing in real estate, nobody would want to buy.
I think there's
Wow.
not, yeah, condos are a hard sell as investments. Like some people buy it as a home, then that's a different story. But I think from an investment point of view, I will only be looking into houses, specifically like multifamilies, ideally with 3 units. Because you buy one building, one structure, then you can live in one and you have two apartments. You have two investment properties. That usually gives you higher returns.
You were living in a multifamily house, right?
Yeah, so that's actually what I did about 3 years ago. So that's where I live now. I live on the top floor of a small brownstone, and then we have two rentable units downstairs.
What do you think are the pros and cons of renting apartments out? Because then you have to take care of a lot of stuff for the tenants.
Yeah, it's definitely a lot more work. For example, like we have to repair the roof because it was leaking. Like the basement was flooded a couple times. Like the boiler is a furnace. It's just like water heater, like things you never have to worry about if you bought in a building. But so those are the downsides, obviously, but the upside is definitely the returns. Because if I just bought a condo, like it will be extremely difficult, if not impossible, in my market to cash flow. It's very difficult. It was difficult when I bought 5 years ago. It will be pretty much impossible now. So it's like you either have to pay or you have to work. You pay more, you get a lower return, or you don't get a return at all if you buy into a building, or you have to buy a house and actually work, with maintenance. And also another downside is with people living downstairs, is sometimes there can be a privacy issue, even though there are separate entrances, but you might run into basic strangers like at the main door, the main front door, or if something happens, if you have bad tenants who are loud in the middle of the night, and it's like having bad neighbors. So there is also like a privacy sacrifice a little bit as well.
And what is the current interest rate in the market right now in the US?
Probably in the high sixes, so 6.8 for a 30-year mortgage. I haven't been following it as closely as I was, but I think that's where we're at.
It sounds very high compared to the interest rate in Switzerland.
What is it? What is it in Switzerland?
It actually went down. So before in the first year when COVID just started, it was 0.65%, 0.8%, or 1%. And then it increased to 3%, and now it came down again to around 1.5 to 2%, depends on
Like,
how many years of
yeah.
you want to get.
What's a typical amortization period?
It's very different. You don't have to pay back. You can have the loan forever as long as you have 35% of the equity. So you pay 20% down for the apartments that you're living yourself, and then the 15% of the rest of the value, and then you have to pay back in 15 years. So you pay about 1% per year. So after you paid 35% of the value, which you own the 35% of the equity, the rest of 65% can be financed forever as long as you are qualified to get a loan.
But every month you pay down the principal as well, or is it
No, it's just the principal is the 15% you have to pay back within 15 years. But after 15 years, you have your 20% down payment, you have the 15% you already paid back, and then
Mhm.
65% of the principal can be as the loan, as the mortgage, can stay forever.
Okay, so every month you just pay the interest, like forever.
Exactly. Yeah, forever.
Oh, interesting.
So the monthly payment is actually much smaller in terms of cash flow wise, compared to in the US or other markets that you have to pay back the principals over 30 years.
Oh, wow, that's interesting. So basically the loan may is will never be paid back.
Yeah, if you are qualified, some people retire, they have much less income, and then the loan expired. For example, you have a 10 years mortgage, and after 10 years, the bank will evaluate your affordability. And then if you don't have any income or very low income, maybe you are not qualified. But usually people have that discussion with their bankers before retirement. But I think usually it's not a big issue because the interest rate did not fluctuate so much, like from 1% to 6%. It was from 1% to 3%, and just for a couple of years, then it came down again.
Wow, wow, that's amazing. Maybe I should
Yeah,
invest in Europe. The rates are so
but foreigners cannot buy here, so that's why very stable market. I have another question regarding the challenges or mistakes, not necessarily the ones you have made, but you maybe you've seen other people making mistakes while investing in real estate.
I think the biggest risk, and thankfully I haven't encountered it myself, is getting bad tenants. And this varies from state to state as well because every state has its own laws. But in my state, New Jersey, it's a very tenant-friendly state, so the legislation, more often than not, protects the tenant rather than landlord. So if you get a bad tenant who doesn't pay or who destroys a property, the landlord's almost guaranteed to lose a lot because you can't just kick them out. You have to wait a certain period of time, and then you have to go to court and serve them an eviction notice, and you take them to court, and then you have to get a judgment from a judge. And the whole thing is probably like a whole years of rental income lost, plus your time, your legal fees. So definitely screen your tenants diligently because I think that's the single biggest threat if you get someone, who doesn't pay or completely destroys a property and then disappears. That's my biggest fear.
How about for buying when selecting a property? What kind of mistakes people can make?
Obviously, location matters a lot. Also, I think the location pretty much determines what kind of tenants you're gonna get. Because if we consider the medium income level in a certain neighborhood, if you buy in a not so great neighborhood, there you might get people who might have more issues just struggling to pay rent. But if you buy in a more higher income neighborhood, usually your risk is lower. It's never zero. But also looking at the saturation, we bought a house in Florida as a rental, but it didn't do so well. So we actually sold it last year. Because where I live now in New Jersey, there's basically no land. Land is just extremely precious. Like all the buildings here, basically there's no land, not even space for parking. But where we bought in Florida, there was a lot more land. So like new developments kept popping up. So that obviously just injected a lot of supply to the market. So, that was not a profitable property for me because partially, no, I think mostly because of the market that I didn't select so well because land was so available and new developments kept, even in Austin, we had the issue of excess supply because people kept building and building there and pretty much the market crashed in Austin, even though we did well the first couple of years. But during COVID, it had a meteoric rise, but then it came crashing down.
Okay, location. So during the process, like the search process, right? I wonder how is it like working with an agent in the US because it's very different in Switzerland. In Switzerland, basically you find a property online and then whoever is the agent in charge of selling that property, then you get in touch with him to for viewing, and then you look for another property yourself and there's another agent. It's not like what I've seen in some market that you can work with one agent, then the agent will help you to find a property for you. So how is it like in the US?
Yeah, usually you have one agent, the buyer's agent, and then you buy it through him or her. So he or she will liaise with the listing agent, with the seller's agent. It's possible that the seller's agent also becomes your agent. So if you don't have your own agent, if you go to an open house, and then the listing agent will almost definitely reach out to you and try to represent you. So In that case, the listing agent becomes a dual agent, but there's some inherent conflict of interest there because the agent has to represent the best interest of the landlord, the seller, but also you. So I would prefer to have my own agent because it doesn't really matter because seller pays both agents. So it has no impact on the buyer. So I think it makes sense to have your own representation, which is, the majority of the time anyway.
Oh, so in the US, as a buyer, you don't have to pay agent fee. It's the
Uh,
seller.
it's negotiable and anything can happen, but that's the common practice.
Oh. What is the percentage of the agent fee?
It's also negotiable. We had a like big suit on this 2 years ago. So it was always negotiable. There is no legally mandated percentage, but commonly it's 5%, maybe as high as 6%, but it's something you can negotiate. So when I sold my house, I only paid 4%. Then it could go down to 3, but I would
Oh,
say
okay.
the 5 is a reasonable.
5% is split between buyer's agent and seller's agent. Okay.
So 5 for each.
Okay, I understand. Can you, as a buyer, work with different agents?
You can, but ultimately, when you enter the contract, you can only have one agent's name. So that's ultimately it's whoever represents you in the deal that gets completed will get the commission.
So probably you can work with different agents in the search process, but when you confirmed which property that you want to buy, maybe this agent help you to find that, and this agent would be in the contract that get the contract.
Yeah, now it's also pretty new, but now a lot of brokerages will ask you to sign a buyer's representation form. So basically, they want to claim you for a certain territory. So if you say, I designate so and so as my agent for the town of Hoboken or Jersey City, then that will be their territory. So if you decide to buy anything in that territory within the time limit, then they will be entitled to the commission. But
Mm,
everything's negotiable, but you could even say, I only want this agent to represent me for this property, this
okay.
town day.
No, okay, understand. Yeah. And looking back, were you glad that you invested so early and now the market has changed so much?
Yeah, especially because of the interest rates, because I locked in interest rates into twos, like two, because I also refi like during the first year of COVID because the interest rates kept dropping from March of 2020 until basically throughout 2021. So actually refied 7 months after buying a place. So yeah, definitely. So now it will be much more difficult because the property values have gone up and the interest rates have gone up. I should have probably invested even earlier, but I
Mm.
do.
Everybody said that. Every investor said that. Yeah. I have another question about the mortgage. How does the lender evaluate if you can afford this much mortgage or not?
They usually use DTI with debt to income ratio. So they calculate your monthly mortgage payment divided.
Without principal, just mortgage.
Monthly payment will be principal and
Oh,
interest.
okay. Yeah, the cash, okay, cash outflow divided by your income. What is the minimum?
It varies by lender, but I think it could be as high as 50%. So if your mortgage payment, monthly payment is 2,000, your monthly income should be at least 4,000.
Yeah, I see. 50%. And they use the actual interest rates that they can offer
Yeah.
you to make the calculation. Oh, okay, it's different. In Switzerland, they use assumed interest rate, which is 5%, even though the actual interest rate is much lower.
Why?
So they in the calculation, they assume this interest rate is 5%, and then some banks add another 1% for they call it like Nebenkosten is like additional cost, monthly cost, some maintenance, utilities, etc. So it's more like 6%. And then it cannot exceed 1/3 of your income. So that's why it's very difficult to get a mortgage in Switzerland. Eventually, if you can get a mortgage, that means your actual monthly payment for your apartment is much, much lower than the calculation. So like the banks has a big buffer, and then you as a person who owns the property also has a very big
Yeah,
buffer.
that's good. That's
Yeah,
good.
The market is quite stable in that way, but you almost cannot find a 7% return rental property in the market.
Okay.
Yeah, maybe
Like,
below 4%, around
yeah,
3%, that's common. Yeah.
yeah, same here, especially with like condos
Okay.
of fixer upper, then there may be more value to be extracted, but that's a lot of work and
Yeah. Okay. Yeah, thank you so much for being here, Nishi, and thanks for sharing with us your experiences. I know you are also a real estate agent now. If you would like to let us know which area do you focus on, maybe some of the audience might be interested and reach out to you.
yeah, should I just share maybe like my Instagram or to
Yep.
email? I'm licensed in New York and New Jersey, mostly like New York City and Hudson County in New Jersey, so northern New Jersey, pretty much like the suburbs of New York. Yeah. And mostly multifamily because it's like impossible to make money with condos.
Nowadays, with the interest rate. Yeah.
Uh,
Mm. All right. Thank you so much for being here. I really appreciate it.
Thanks for having me.